Hello. So I'm here to discuss Industry 1, Team Ikonik, and this BSG final presentation. Along with me, I do have four other co-participants here. I'm Dimitri Baxter. We have Marissa, Austin, Lisa, and Amanda. And as I walk you through these slides, we'll walk through the business strategy and go over financial results and look over other competitors, and finally lessons learned through this presentation. So as I walk through strategic vision of our company, Team Ikonik, we at year 11, we focused on differentiation strategies, which our focus was high-end materials, multiple styling options. And by year 14, we kind of realized that wasn't working for us. We noticed a lot of other competitors were going in that same market niche, and we noticed it was too narrow. So in year 15, we switched to the best cost provider strategy. And while this strategy focused on satisfying customers' expectations on quality and features, and we wanted to kind of single our company out and try to focus on it being in the middle. And as we go to our first strategic group map for year 11, we noticed that we were in the middle, but it wasn't a big enough we weren't big enough as competitors. And next. And next we have Marissa talking about year 14.
Hi, I'm Marissa, and as Dimitri mentioned, we had to shift gears a tiny bit going into year 14. We were trying to be that high-end group. We wanted to be towards the top right of this graph here, but unfortunately, that's not exactly what happened. What we did end up doing, though, is attempting to increase our models. So here you can see that we shifted more to the right side of the graph with the increase in models. We stayed a little bit the same on the price and SQ rating scale in comparison to everybody else, but of course, we were hoping to have a much bigger market share here, and that's kind of the purpose that we went into when we were increasing models and making these changes here. So it was a little disappointing when everyone else did the same thing. As we can see, A, B, C, D, they're all right next to us, and we are all sort of evenly distributing that market share. Again, that's sort of the opposite of what we wanted to happen in terms of setting ourselves apart. So we did, again, have to make a little bit of a change based on our competitors. Year 11 was, we were just getting into the game, and you can tell here from our net revenues, that definitely wasn't our best year all around the board. So looking at total, it's a definite low point right here from where we started in year 10 to the following years. Wholesale, we did have a good increase from year 11 to year 12 for all of the other categories, actually. So wholesale, internet, private label, especially, we all saw an increase from year 11 to year 12. So we did want to do our best to have that private label market after missing out on that in year 11. And yeah, total sales have had a gradual increase in the years that we're presenting on. And of course, we want to make that a bigger slope there, but we did sort of get the hang of things in terms of increasing our revenue slowly but surely. Okay, now we get to earnings per share. I think this one has a really interesting peak from year 11 to year 12. So that is when we made the change from being in the middle of the chart, middle of everything, to moving into having a lot of models available. So we were playing around on the game. We started to notice that there was a big change in profit when we increased the number of models. So we thought, okay, maybe this is a good way for us to differentiate ourselves while also increasing our net income, right? So that increase in net income clearly really helped us from year 11 to year 12. However, as everyone sort of followed suit and we didn't have the biggest market share, and we didn't end up having that differentiation that we were going for, the EPS started to decline a bit, and that's what we're working to improve right now. So next up, we have Austin talking about our stock prices a bit.
Hi, thanks for that introduction. So as you can see, starting out in year 10, starting at the baseline at $30 per share, our baseline net profit ratio was 9.2%, which was average, was really what we were shooting for going forward. Year 11, really just getting into the game and understanding the mechanics of how things work. Our net profit margin dropped to 4.6%. The industry average stayed at 9.2%. Our year 11 prices were a little too high for what we were delivering to our customers. So we think that's why our revenue really suffered. We didn't really capture the market share that we expected to. Our revenue was only $407K, which was lowest in the industry. So it really caused our stock price to drop a lot. Year 12, we focused on increasing the revenue, continuing to keep the costs pretty low. We made some investments in advertising and celebrity endorsements to kind of increase our star rating and increase our appeal to customers. It did have a positive effect on our revenue. Our revenue went from 407K in year 11 to 577K in year 12. And our margins also increased from 4.6% to 11.9%. So that's really the high water mark of what we've achieved for stocks so far. Year 13, like Marissa said, we kind of noticed that more people started to move into our market space, and our market share didn't really increase going forward. We tried to keep the same strategy, but our sales really stayed flat while we continued to increase our costs. So this led to a drop in EPS and ROE, and it really started to drop our stock price a lot. Year 14, we again tried to keep our focused differentiation strategy. Not a whole lot of change on our strategy. We tried to invest more in advertising and celebrity appeal, but really it just seemed like that market segment was really played out and really crowded. So our stock was kind of flat from year 13, and I think going forward, it caused us to kind of switch up our strategy a little bit. If you want to go to the next slide. Yeah. So our competitor that we're targeting now is company FinAction, which is a low cost. They're doing a low cost provider strategy. They have low models, low price, not really delivering a whole lot of value for the customer, except for the fact that they have, really low prices. That segment of the market seems to be pretty open right now, and that's kind of why we chose to kind of attack it with a best value approach, where we could, have a little more feature, a little higher price, and steal away that customer base from that company. They're an effective competitor. They have, pretty good image rating, despite not having a lot of features on their products. They have pretty good market share, probably due to their pricing, but they continue to have good profitability even with that low pricing. So what they run into is they tend to sell a lot, but they also don't have a lot of celebrity appeal. And I think that our manufacturing metrics and our celebrity appeal is an advantage to us. So if you want to go to the next slide. Yep. So for EPS is really profits divided by outstanding shares of common stock. If the drivers are earnings and outstanding shares. And really for us, it's improving the net margin and also increasing the sales to improve the net margin. So our plan to increase sales is improve brand reputation, increase our SQ rating and our corporate citizenship to give us a better image as a whole to our customers and invest in more advertising. We want to reduce costs where we can or maintain costs so that way our margins stay where they are at least. And if we have a good cash balance, we'd like to buy back shares so that way we can increase we can decrease the number of shares outstanding and causing our EPS to go up. So with that, I'm going to toss it over to Lisa.
Hi there, I'm Lisa Springer, and I'm going to start with the forensic checklist in regards to ROE, so return on equity. The definition is it's a measure of finance performance or profitability, and it's calculated by net income divided by shareholders' equity. And it shows how well we are as a company at managing the capital invested by our shareholders. Drivers in terms of ROE is net income, equity, as well as cost and expenses. We are below average on net income and below average on equity. However, our cost and expenses have remained high. Our most important driver for our team currently is to improve equity, and that includes current and fixed assets, where we want to increase the revenue through higher sales volume and invest in higher quality production equipment in year 15. Next slide. Moving on to the forensic checklist in stock price. The definition is the current price that a share of stock is trading for on the market. It indicates the current value to buyers and sellers. The drivers for stock price are in meeting or exceeding investor performance expectations, for revenue growth and EPS growth. And our most important driver for our team right now is to invest to create more sales. We have consistently beat our cash forecasts, and we have good credit. We intend to use our favorable financial position to invest in the ability to make quality product at a lower direct cost. We will also increase our investment in retail support, marketing, and advertising to grow our customer base. Next slide. Next is our forensic checklist in regards to credit rating. The definition is a credit worthiness depicted as a letter grade. Our drivers include interest coverage ratio, debt to assets ratio, and default risk ratio. Our interest coverage ratio and our default risk ratio have been below average. Our debt to assets ratio has been low, which is good. And all of these three combined result in a medium risk of default. Our most important driver for our team right now is low amount of debt and a high availability of cash on hand, evidenced by our good debt to assets ratio. However, a repetitive theme is we do need to increase revenue and cash flow. While we did not have a bad credit rating, unfortunately, it has not yet met investors' expectations. So next we will have Amanda.
Hey, Amanda, you're on mute right now.
Thank you. Sorry about that. For our image rating, that's the public perception of the company as a whole. Drivers include the global brand SQ, the average shares in branded and in private label, and our corporate citizenship over the past several years. The biggest impact to us is our low market share, and we've got to improve our citizenship. Next. Our 3-year strategy. Basically, we need to increase our sales. Our operation costs are not as high as they could be, but we're just not making the sales. Our strategy changed in year 14, which caused us a loss, but we felt like it was a good positioning. We hope to improve our income by decreasing the number of models, and that did work. Let's see, we want to increase our market shares by investing in retail support and advertising. Our marketing, it's working. We just are not there yet. Next. Lessons learned. Let's see, in round one, we should have gone harder than we did. We didn't know how important that round was going to be. We found that the projections weren't really as helpful as we thought they would be, and we relied on those heavily, and they just didn't get us there. We fell short. We didn't have a real grasp on the numbers, and that hurt us. As we went on, we did figure out how the numbers work together. Changes we made in year 14, even though it lowered our rank in the game, it put us in the position that we wanted to be in. We learned that the market shares were the most important aspect of the game, and we never gained the shares that we wanted to gain. Overall, we learned a lot. We learned how the numbers work together. So that's what I got. On behalf of our whole team, thank you for watching our presentation.